And this is looking at the best and worst performing days of the S&P 500. And you can go through here and look at March 17th. You can go to March 13th. So in less than a month, it's up 9%, 6%. But let's just start with there: 6, 9, 3, 9, 6, and 7. So well over 20% in a matter of 3 weeks on those up days. If you're out of the market and you're in cash trying to avoid some of the worst days, that's a big move in the market to be out. If you didn't time that well and got out at a higher price than that and you missed that upswing, you've missed out on a lot of money. I think more money has been lost sitting on the sidelines than money's been lost just waiting it out. But we have pieces like this by BlackRock.
Yeah, this is pretty similar. Looking back to 2002 on the S&P 500, said, what does a $100,000 investment in the S&P look like? And by the close of last year, it was $616,000. But if you had missed the 5 best trading days like you're talking about, you'd have to, we would call this data mining, because it'd be pretty hard to miss those 5 days, but this fits the narrative. So you miss out on 44% of your gain. So it's significant, and it's not going to happen to a long-term investor, but a trader certainly, look at last week.
I think it would happen to Brian McGee.
A trader could easily have sold last Thursday, see the rip up on Friday, and then got back in at the highs. So.
Right, absolutely. But this is only one side of the story, right? Mm-hmm. So many of the wholesalers present this to advisors. Advisors will then present it to the clients, and it's a good story. It's a good reminder. Mm-hmm. But what would happen if you missed the 20 worst days? Because isn't that the other side of that? Well, this slide, the 20 worst days would be green, and then the 20 best days, missing those days, would be red. And then you have a purple line, which is really you miss both best and worst. And then you have a buy and hold, which is also that blue line. And that blue and the purple are basically there. Well, it tells me one thing, a couple of things. One is that the best and worst days, there's not like best days are up substantially or worst days are worse than best days. They're basically the same. The volatility is on the downside and the upside. Another thing that it says is you got to be really careful about trying to time it, because you want that green line. You want to miss those worst days. They're often followed by the best days, so timing is going to be really hard. But if you're in that blue, or you're in that the purple, or you're in the green, your retirement's fine. But if you're in that red, you're not. So that's a risk that you're taking by being out of the market. Once again, more money has been lost sitting on the sidelines than what has been just left in the market. So you want to be very cautious about doing that and really consider what you're doing, because a lot of times when you want to get out of the market and you want to go to cash, a lot of the downside has already been realized, and then that means a lot of that upside is coming. And once again, remember, those up days are 9-10%, and they are back to back. All of a sudden you've missed most of the rise. So it's really you really have to be cautious whenever you're thinking about going to cash, and we have been. That's one of the reasons that we've just sought to just take out some of the edge. Now where we spent, if we've taken off the edge and we've gained against our benchmark the last quarter, we definitely felt that edge coming into the end of 2021 and into the beginning of 2022.
Thank you for watching. Be sure to like the video and press the subscribe button right here so you never miss an update. If you have any questions or would like to get in touch with an advisor, click the link in the description below to request a meeting. We'll see you next time.